Cost accounting 8A, contribution margin and margin of safety. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, email, and website. The book Cost Accounting for Dummies is available in March of 2013, and here's our Twitter account. I wanted to take two looks at contribution margin, starting off with some concepts. You'll recall that contribution margin is sales less variable costs, and another way that I describe it is it's what you have left to cover fixed costs and profit. So if I take sales less variable costs, as we'll see, what I'm left with is money to cover fixed costs, and anything remaining is profit. And a second point that relates to this question is using fixed costs per unit, which I mentioned here is misleading. You should consider fixed costs only in total dollar amount. Now, I've left fixed costs per unit in this question because you'll see fixed costs per unit used a lot in test questions. But in practical use, you should only consider fixed costs in total dollar amount, and here's why. If you have more production or sales, you're spreading the same fixed cost over more units, so your fixed cost per unit goes down. But what that gets you away from, and it takes the eye off the ball, I think. Total fixed cost doesn't change regardless of how many units you produce. That is, you still have to cover that fixed cost. So I always like to mention that when fixed cost per unit comes up. So here's what we're given. A company has budgeted sales of 500 units. And here's some details from the income statement. Selling price, direct material and labor, and you see per unit amounts over here. We have two kinds of manufacturing overhead, variable manufacturing overhead and fixed manufacturing overhead. We consider shipping and handling to be a variable cost that goes up and down with the number of units we sell. And finally, we have a fixed selling and admin cost. So if I add up my per unit costs, 88, and I subtract 88 from 100, the sales revenue, I get my profit in brown of 12. And you'll also notice that I took the 500 units and I multiply it by $20 per unit, and I get that $10,000 total fixed overhead, which is the number that I need to cover in my sales. Just to point out that total dollar amount that I was getting at in the concepts above. So now the question. Assume that the company's actual sales total 800 units. Total fixed manufacturing overhead is 12,000 versus the 10,000 we saw above. The actual sale price is 95. Direct material cost per unit decreased by 10%. And the question, what is the company's actual contribution margin per unit and in total dollars? So the question's about contribution margin. And so in the solution, I suggest a couple of steps. Step one is input the changes into the calculation and remove fixed costs because they're not part of the contribution margin formula. So any part of the costs that are defined as fixed we don't include because that's not part of contribution margin. So I have 800 units. My selling price went down to 95. My direct material decreased by 10%, so I took the $20 original direct material amount and multiplied it by 90%. So we're down to $18 direct material. And then we have direct labor, unchanged, variable manufacturing overhead. You'll notice that I took out fixed manufacturing overhead, and over here I say fixed costs are excluded. Shipping and handling per unit remains. Fixed selling and admin is removed. Fixed costs are excluded. And then over here in this formula, I simply multiply all the numbers by 800 units. Whoops. This one's multiplied by 800 units, etc., all the way down. And so I take my sales less my variable costs, fixed costs excluded. I take that difference and I get contribution margin per unit, blue minus green, of $32 a unit. And when I multiply across 76,000 my revenue in blue less 50,400 my total costs in green, I get contribution margin in dollars of 25,600. The other question on this video discusses contribution margin and margin of safety, and this is an interesting angle, an interesting take on these two concepts. First of all, contribution margin we already defined in this video. Margin of safety, though, is different. I can define it a couple of ways. Actual or budgeted sales, depending on what you're using, minus break-even sales. And there's a couple of ways to think about it. The first is it's the cushion, if you will, or the sales that you generate above break-even. It's your breathing room. Also, margin of safety is the total dollar amount of sales, the total dollar amount, of sales decline you can incur before you reach break-even. The amount of sales decline you can incur before you reach break-even. And then a third definition, and this is the twist in the problem that I think is a good one. When I am at break-even, my fixed costs equal my contribution margin, or in other words, sales minus variable cost equals fixed costs, and that should make logical sense, because if sales less variable cost less fixed cost equals 0, I'm at break-even. So therefore, if I sell 100, have variable costs of 50, I have $50 left, and my fixed costs are also $50, I have a 0 profit. So here's the question, and it's a tricky one. A company has sales of 100,000, a contribution margin of 10%, and a margin of safety of $20,000. Again, you got to say dollars versus units. And the question is, what are the company's fixed costs? So step one is, if I have sales and I subtract my margin of safety, by definition, that gets me to my break even. So my sales were 100,000, my margin of safety is 20,000, and I get to break even in sales. It should say break even in dollars of 80,000. That's my break even by definition. Has to be that amount. Step 2, and I'm correcting the header here. Use the break-even sales to contribute the contribution margin in dollars. So, I know my break-even in dollars is 80,000. I'm given that my contribution margin is 10%, which means that in dollars, my contribution margin in dollars at break-even must be 10% of 80,000 or $8,000. That's my contribution margin in dollars. And lastly, we learned that at break-even, my contribution margin is equal to my fixed costs. So if my contribution margin at break-even is 8,000, my fixed costs must be also 8,000. So we've used the concepts of contribution margin, margin of safety, and break-even point. And the important one for the video is this one, is that at break-even, fixed cost equals my contribution margin. And you had to know that to figure out this part of the question. That's as far as we'll get on Cost Accounting 8A. We have video textbooks on the website, additional videos and spreadsheets, some on YouTube, some are not. My YouTube channel now lists, my website now lists all the videos on my YouTube channel. You'll see video links on my website for all my YouTube videos grouped by type. So I have management accounting page, cost accounting, etc. For live one-on-one tutoring and live chat sessions, there is the website. And bear in mind that we're teaching a free online course that's ongoing every month, teaching the concepts from my book, Cost Accounting for Dummies. Thanks very much, and we'll see you next time.